Some notable examples. As in corporate America and in investment America, there were some particularly bad apples in the giant barrel that represents the fund industry. Gary Pilgrim and Harold Baxter. These two fund executives not only allowed certain preferred hedge funds to engage in market timing schemes, but, through a hedge fund in which they held personal interests, even did so themselves. Since the inception of the Pilgrim-Baxter Holding Group funds in 1985, their funds had operated under frankly speculative policies. They engaged in aggressive short-term trading tactics and provided volatile returns both up and down. But however spasmodic were the eye-catching returns periodically achieved by their funds, the firm hyped them in opportunistic advertising and drew huge investor capital to their funds after their good performance had been achieved, and almost inevitably just before it turned sour. The result? Investors in the PBHG funds incurred literally billions of dollars of losses, while Pilgrim and Baxter earned at least $1 billion of profits at their expense. Their settlement with the SEC and Attorney General Spitzer included fines and reimbursements to the funds totaling $160 million, a virtual drop in the bucket that was filled to the brim with their ill-gotten gains. In settling the civil charges, they neither admitted nor denied guilt. Richard Strong, principal owner of the management company that countenanced and encouraged market timing in the Strong funds, also did such timing for himself and his friends and family members. While criminal charges were considered but never brought against Strong, he was barred from the industry for life, without his admitting or denying guilt to the civil charges. His firm's monetary penalty of $175 million was among the largest assessed against any fund manager. He was well compensated for his efforts, however, including $217 million of fees paid to the manager by the funds during the 1992-2002 decade, and an additional reward estimated at $400 million when the management company was sold to Wells Fargo Bank a year after the scandal. James Connelly. This former brokerage vice chairman and head of mutual fund sales and marketing for the Alger funds apparently was an early adopter of the strategy of increasing the management company's revenues by allowing abusive trading in their mutual funds. Beginning in the mid-1990s, Connelly devised a system that permitted timing in Alger's mutual funds that, by 2003, had provided the firm more than $200 million in assets from more than a dozen investors. Once he became aware of Spitzer's investigation, Connelly compounded his troubles by tampering with the evidence. He was fined $400,000, barred from the investment business for life, and sentenced to 1 to 3 years in jail. Ironically, in 2002, an industry publication had named Connelly its Fund Leader of the Year. Lawrence Lasser. This longtime chief executive of Putnam Management Company consistently ranked among the highest-paid executives in the fund industry, with compensation totaling $163 million during 1998 to 2002 alone. In 2004, Putnam reported that Lasser was made aware of improper trading by portfolio managers as early as 2000. Ultimately, 40 Putnam employees, including 6 portfolio managers, were implicated. Upon learning of this breach of fiduciary duty, Lasser neither disciplined nor terminated them. Nor did he inform the management company or the fund directors or the fund shareholders or federal or state regulators of the malfeasance. Putnam later agreed to pay $193 million in fines and restitution to their fund's shareholders. Although he was charged with neither civil nor criminal misconduct, he eventually was awarded a termination bonus of $78 million. Of Lasser, it might be said, nothing succeeds like failure. As in corporate America, the names of many other bad apples could easily be added to this list. Executives from more than a score of major mutual fund management companies, including some of the oldest, largest, and once most respected firms in the field, have been implicated in the scandals and disciplined, often severely, by regulators. Similarly, the fund misconduct went far beyond a few isolated incidents involving a handful of wrongdoers. The problems are far more systemic, for the barrel of mutual fund capitalism is itself riddled with conflicts, reflected not only in the scandals involving market timing, brokerage payments, and overcharging for sales loads, but in excessive management fees and fund expenses and overzealous marketing of speculative funds, where the financial losses inflicted on fund owners by fund managers were far greater.